Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Rayonier Inc. Annual Report. Rayonier is a leading company that specializes in timberland real estate investment trust. The company's primary focus is on managing and investing in large tracts of land with high-quality softwood timber growing regions in the United States. Specifically, Rayonier owns or leases approximately 2 million acres of timberlands across two main regions, the U.S. South and the U.S. Pacific Northwest. The company's business primarily revolves around owning and managing vast areas of timberland, which suggests that its core services include land management, forestry, and possibly logging operations. The decline in Rayonier Inc.'s stock price over the past year can be attributed to several key events and factors. One major contributor was the weak timber market conditions, which led to lower demand for pulpwood and timber. This resulted in decreased average pine sawtimber and pulpwood stumpage realizations, further exacerbated by an influx of salvage timber. The Q4 2025 earnings report also revealed a year-over-year decline in net income and a weaker performance in the timber and forest segments. The company's forecasted decline in adjusted funds from operations, AFFO, for 2026 added to market concerns, leading some analysts to rate the stock as hold due to weak AFFO growth and cyclical risks. The merger with PotlatchDeltic, while offering scale and synergy potential, introduced higher leverage and integration risks. The divestment of Rayonier's New Zealand joint venture also increased its vulnerability to regional demand and quality headwinds. Furthermore, the reduction in dividend payment from $0.2725 per share to $0.26 per share was perceived negatively by investors. Lastly, negative technical signals and a price drop in early 2026 contributed to the decline in Rayonier Inc.'s stock price. The combination of these factors resulted in a significant drop of over -9.04% in the company's stock value over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of various segments within the company. The real estate segment saw significant increases in revenue due to large dispositions and improved development. Additionally, the Pacific Northwest timber segment experienced a surge in revenue from trading and license revenue, primarily from hunting. On the other hand, some segments faced declines in revenue. For instance, timber sales revenue decreased due to a decline in stumpage pay-as-cut revenue. However, delivered wood domestic revenue saw an increase. The company's acquisitions of higher and better use properties also contributed to revenue growth. The impact of these drivers on the company's overall revenue can be seen in the changes in selling and general expenses and cost of sales. While selling and general expenses increased in 2024 compared to 2023, cost of sales decreased. These fluctuations highlight the importance of understanding the underlying factors driving revenue growth or decline within different segments of the business. The net income of a company underwent significant fluctuations between 2023 and 2025. In 2023, the net income was $178,495, but it decreased to $368,983 in 2024. However, there was a notable increase in 2025, with the net income reaching $480,413. This change can be attributed to various factors, including the sale of New Zealand operations and a gain on the sale of discontinued operations. The profit margins also experienced changes during this period, although the exact figures are not provided. It is inferred that the profit margins were affected by sales and operating income data. The possible reasons for these changes include changes in tax rates and credits, foreign currency exchange and interest rate contracts, and other factors. However, it's essential to note that the information provided is incomplete or missing in some cases, making it challenging to draw definitive conclusions about the changes in net income and profit margins. The increase in net income in 2025 can be attributed to a gain on the sale of discontinued operations, which contributed significantly to the overall net income. On the other hand, the decrease in net income in 2024 may have been due to various factors, including changes in tax rates and credits, foreign currency exchange, and interest rate contracts. The sale of New Zealand operations also resulted in a decrease in net income. In conclusion, the the net income and profit margins of the company underwent significant fluctuations between 2023 and 2025. While there are several possible reasons for these changes, the exact figures and explanations are not always provided, making it challenging to draw definitive conclusions. The company's financial performance is a testament to its ability to generate positive operating cash flow. Over the past 3 years, the company has consistently produced substantial amounts of operating cash flow. In 2025, the company generated $256,661 in operating cash flow, demonstrating a strong foundation for future growth. A closer look at the data reveals that the company's operating cash flow has been steadily increasing over the years. In 2024, the company generated $261,592 in operating cash flow, representing a slight decrease from the previous year. However, this minor dip is more than offset by the significant increase seen in 2023, where the company produced $298,375 in operating cash flow. Overall, these figures indicate that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. This trend suggests that the company has a solid foundation for future growth and success. The company's financial performance indicates a notable reduction in its interest expenses. According to the extracted summaries, interest expense net decreased by $2,405 from 2024 to 2025, and further decreased by $10,633, $7,405 plus $3,228 when comparing 2023 to 2025. This significant decrease suggests that the company has made efforts to reduce its financial obligations. In contrast, the debt level of the company has remained relatively stable over the past 2 years. The total principal debt has remained unchanged at $1,050,000 since 2024, and the total debt is also reported to be $1,050,000 with no change in 2025. This stability in debt levels suggests that while interest expenses have decreased, the company's overall financial obligations remain consistent. Overall, the data indicates a notable reduction in interest expenses, but a stable debt level. The performance of various segments within a company can be analyzed based on extracted summaries. 2 regions, Southern Timber and Pacific Northwest Timber, have been identified as performing differently. The Southern Timber segment appears to have performed well, with positive results mentioned on page 3. However, there is limited information available for this segment, with no specific performance details provided on pages 6 and 36. In contrast, the Pacific Northwest Timber segment has shown poor performance, according to page 3. Similar to the Southern Timber segment, there is a lack of detailed information regarding its performance on pages 6 and 36. Management's outlook for the company is centered around long-term growth, with a focus on sustainable yield and stable cash flows. The company plans to continue investing in timberlands, pursuing alternative uses for its properties, and evaluating opportunistic real estate development investments. A nimble capital allocation strategy will be executed to build long-term value per share, including selective acquisitions and dispositions. The merger with PotlatchDeltic Corporation is expected to significantly expand the company's timberland portfolio and introduce wood products manufacturing capabilities, enhancing its scale, geographic diversity, and growth prospects. Management is also prioritizing sustainability and environmental considerations, monitoring climate-related initiatives and regulatory developments that may impact the business. In terms of financials, the company expects dividend payments and distributions to be approximately $319 million, with future share repurchases dependent on liquidity, cash flow, and market conditions. The company has a strategy of providing credit support for certain suppliers and vendors through off-balance sheet arrangements. Overall, management is committed to executing a long-term growth strategy that balances financial returns with sustainability and environmental considerations. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the most notable ones include the purchase of Pope Resources and a merger with PotlatchDeltic. The merger was structured as a merger of equals transaction, indicating a significant partnership between the two companies. On the other hand, the company has also made several divestitures to optimize its portfolio. These include the sale of 77% interest in a New Zealand joint venture and a New Zealand subsidiary. Additionally, the company was unable to sell certain properties at attractive prices, including HBU properties and non-strategic timberlands, due to changes in investor interest. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. In the year 2025, the company paid out both ordinary and special dividends, totaling $2.49 per share. This demonstrates the company's commitment to returning value to its investors. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, in 2025, it purchased a total of 119,565 shares. This move not only benefits existing shareholders, but also helps to reduce the overall number of outstanding shares, which can have a positive impact on earnings per share. Concerns about inventory buildup or supply chain disruption are evident in the provided summary. On page 19, supply chain disruptions are mentioned due to higher tariffs, reduced margins, and constraints on capital investments. Additionally, changes in timber supply and pricing may impact business, as noted on page 20. The potential for disruptions is further emphasized by weather conditions that may limit timber harvest and sales, page 21. Natural disasters can also reduce the volume and value of timber that can be harvested, while manufacturing facility disruptions could prevent meeting customer demand. Raw material shortages, equipment failures, and transportation infrastructure disruptions are other potential risks to supply chain. Inventory buildup is specifically mentioned as a concern on page 74, with an increase in inventories by $2,006 from 2024 to 2025, noted on page 81. A non-cash asset impairment charge, recognized on certain higher and better use timberland assets, page 133, also suggests potential concerns about inventory buildup or supply chain disruption. That concludes the financial summary for Rayonier Inc. Feel free to comment below, and I will be happy to answer them when possible.